We're proud to welcome you to the Exceptional Advisor podcast series brought to you by the Investments and Wealth Institute. This series aims to help you to better serve your clients, differentiate yourself from the competition, and enhance your ability to communicate those differences. Hi, I'm your host, Bob Powell. My guest today is Mary Beth Franklin. She's a Social Security expert, an award-winning author, and a keynote speaker. She's the author of Maximizing Social Security Benefits, and she joins us now. So, Mary Beth, welcome to the podcast.
Thanks, Bob. I'm delighted to be here.
Delighted to have you here. Before we get going, for the benefit of our listeners who may not be familiar with you and your work, the very few listeners who may not be familiar with you and your work, can you give us a brief overview?
Yes, actually, I've been a journalist for more than 40 years, always writing about money in some form. From the days I was a Capitol Hill reporter in the 80s for United Press International, where I covered tax reform and Social Security reform, through the days that I was writing for consumers, through Kiplinger's Personal Finance magazine, and for the past decade writing for financial advisors for the audience of Investment News. And along the way, I also became a certified financial planner.
So we have that in common. We're both CFPs, and we both love talking about Social Security. And I want to start here, Mary Beth. What advisors, when you think about the knowledge, skills, and abilities that advisors need to have to hold themselves out to be a retirement planner, retirement income expert, they need to know the ABCs of Social Security. But what exactly do they need to know? Do they need to know Amy? Do they need to know Ben points? Do they need to know how the calculation is done to figure out someone's PIA?
I don't think they need to go that far into the weeds because there's good software programs, there's training programs, there's consultants who can work with you and your clients, but you do want to know key milestones. You do want to know that while it's true, people can claim Social Security retirement benefits as early as age 62, and while that may make sense in certain circumstances, they have to realize that those benefits will be reduced for the rest of their lives. And if they claim before their full retirement age and continue to work, either in self-employment or as a wage earner, their earnings could mean that they could temporarily lose some or all of their Social Security benefits if they make too much money. And this year in 2023, too much money is about $21,000 a year.
Right. So it seems like in terms of the ABCs, they need to know enough to help their clients decide whether they'll be subject to a penalty in terms of claiming early, whether their earnings will be affected or their Social Security benefit will be affected by working while and claiming before full retirement age, and that there might be a delayed retirement credits if they wait to claim.
Right. And for many advisory clients, you have generally white collar workers who are now out there, shoveling or lifting bricks. They can work a long time. And for people who are likely to live longer than the average life expectancy, which is for 65-year-olds, roughly around 85, 86, these people would be the ones who would benefit from delaying their Social Security benefit up until age 70. So that's another key ABC. If you have clients that don't need the money, who can afford to delay, and then you look at the marital status. I think it's important for one spouse, not necessarily both, to delay up until age 70 if possible, to create the largest possible retirement benefit while both spouses are alive. And that spouse tends to be the husband, who tends to be a little older, who tends to make more money, and is likely to die first. So by having him delay to get the biggest retirement benefit possible, he is also creating potentially the largest survivor benefit for his widow. So those are the key milestones that financial advisors need to be aware of to work with their clients to explain how Social Security is just one piece of an overall social retirement income plan, but for so many people may represent the only source of guaranteed income that lasts the rest of their lives, no matter how long they live in this era of disappearing pensions. And very important, it's cost of living adjustment. And even if you have a pension, unless you work for the federal government, it's unlikely that pension is adjusted for inflation.
Yeah. You just mentioned something that I think is worth noting when I think about income replacement and I think about how much income Social Security replaces for those in the lowest income quintile, it represents about 85%, if not more, of their pre-retirement income. For those in the highest income quintile, it may represent only 15%. Do you have any thoughts about how advisors need to think about, this notion of how much income Social Security replaces of a pre-retirement income?
Right. I mean, the rule of thumb is for the average worker, it might be 40%. For your clients, it's probably going to be 25% or less. Now, in terms of dollar amount, those higher income workers are going to receive a bigger Social Security check. It might be over $3,000 a month, but it's going to represent a smaller piece of their pre-retirement earnings, a smaller replacement rate. So obviously your advisory clients are going to need other sources of income. They probably have employer-based retirement plans, whether it's a 401k or 403b if they're in the public sector. Maybe they have a pension. The big issue, I think, for advisory clients is these people are generally going to be slammed with taxes in retirement. We all believed that myth years ago that we should shovel all of our money into tax-deferred 401k plans because, of course, we were going to be in a lower tax bracket in retirement. Well, that doesn't seem to be the case these days. So for your clients, their big concern is how much they're paying in income tax, and the great surprise of retirement, how much they're paying in Medicare premiums, because their Medicare Part B and their Medicare Part D prescription drug plans are tied to their retirement income. So I think the financial advisors, they really need to crunch numbers to see how much their clients are likely to get in Social Security based on their claiming strategies, their ages at the time, their marital status, what percentage of that pre-retirement income that might replace, and now look at how we can get some of that tax-deferred income, like 401ks, into some tax-free columns, either through health savings accounts during their working years, through contributions to a Roth IRA or Roth 401k, and Roth conversions. Because now we have this very interesting period, the runway of when people retire and when they have to start taking money out of their retirement accounts has now increased. The Secure 2.0 Act means people who are 72 or older this year don't have to start tapping those retirement accounts with the required minimum distributions until age 73. So say you have somebody that retires at 62, they may have 11 years to get money out of their 401ks or IRAs, and they may have a little more control over their income. They probably have less income now than when they were working in their peak earning years. It can be a great time to do partial Roth conversions each year to get some money into those tax-free pots. Now, we have a little bit of urgency because I believe we are living in probably the lowest tax bracket we will ever see in our lifetime. And as the current law is written, this was a result of the Jobs and Tax Act of 2017, those current low rates are going to expire at the end of 2025. Now, it's possible they could be extended, but there's no guarantee. So basically, you have people who could take money out of their 401ks or IRAs now at the lowest available tax rates and maybe get them into some tax-free accounts. I think it's a good strategy.
Yeah. So speaking of strategies, the Bipartisan Budget Act of a couple of years ago removed some of the great strategies, but there's still a couple left.
Yeah, the one big strategy that is left is for people born before 1954, meaning the last group of people who are eligible to use this will turn 70 by the end of this year. If you have clients in that situation who are married, and let's say it's the husband and he's going to turn 70 in December 2023, and he hasn't claimed Social Security because he wants to wait for that biggest benefit. But say his wife has already claimed her Social Security. Because he's born before that magic date of 1954, he can right now file what is called a restricted claim for spousal benefits. That means he could collect half of his wife's full retirement age benefit amount, while his own retirement benefit continues to grow by 8% a year up to the maximum amount at age 70, and then switch to his maximum benefit. And here is an added secret that most advisors don't know. When you claim benefits as a spouse, your biggest benefit is when you claim it at your full retirement age. In this example I just gave you, this person's already 69 plus. He could not only file a restricted claim for spousal benefits and get paid half of his wife's full retirement age benefit amount for the next few months, but because he's over full retirement age, he could also say to Social Security, and give me 6 months of retroactive benefits in a lump sum. Because people who claim benefits after their full retirement age can request retroactive benefits in a lump sum up to 6 months. Now, for people claiming on their own retirement record, it doesn't usually make sense because you either claim a retroactive benefit or you earn a delayed retirement credit. You can't do both for the same period. But in the case of spousal benefits, when they max out at your full retirement age, why not ask for an extra 6 months of benefits?
So many details to learn, Mary Beth. So we're talking about married couples. One of my favorite topics is you mentioned sort of like maybe the highest income earner delaying till 70 and letting the younger, perhaps spouse, lower income earner claiming. Any other strategies that are worth mentioning when it comes to married couples?
Well, as you mentioned, yes, I think one person should wait till 70 if possible. Having said that, let's say the wife, but Social Security is gender neutral. Let's say she's got her own benefit and she's 62 and she's no longer working. Heck, let her go ahead and claim reduced retirement benefits now, just as a way of bringing some income into the household, take away a bit of the sting of having the other spouse wait. And here's one of those other great secrets. Even though her retirement benefits would be reduced for the rest of her life because she claimed them early, it will have no impact on her survivor benefits. As long as she is at least full retirement age when she claims a widow's benefit, she will still be entitled to 100% of what her late husband was either collecting at time of death or was entitled to collect if he died before claiming.
Right. What about, you mentioned widows and widowers, any special things that advisors need to think about with respect to that class of people?
Absolutely. Going forward, so at the end of 2023 will be the last of these creative claiming strategies for married couples, of the idea having one spouse claim and having the other file restricted claim for spousal benefits. That goes away at the end of the year. But going forward, regardless of when you were born, if you are married, or if you are an eligible divorced spouse, meaning you have been married at least 10 years before divorcing, and your husband, wife, or ex-spouse dies, you may be entitled to both your own retirement benefit and a survivor benefit. And those two benefits, retirement and survivor, are two separate pots of money. You may be able to claim one type of benefit first and switch to the other benefit later, and you could do it in either order, however benefits you the most. The key for advisors to remember is I want to collect the bigger benefit last because that's what's going to last me the rest of my life. So here, two examples. Husband dies, wife is young, she's 62, she's not working, she's entitled to her own retirement benefit and the survivor benefit, but the survivor benefit is bigger. She should probably claim her own reduced retirement benefit first, and when she gets to her full retirement age, switch to full survivor benefits. Now let's flip that around. We have a business executive. His wife dies of breast cancer. He's entitled to a survivor benefit too, but it's smaller than his retirement benefit. He's still working. He probably wants to wait till his full retirement age when earnings restrictions go away and when survivor benefits are worth the maximum amount and claim his survivor benefit. In the meantime, his retirement benefit continues to grow by 8% a year up until age 70, and then he switches to his maximum retirement benefit. So you can see this gets complicated depending on what sort of software your platform uses, or if you don't have access to that, you can work with groups like Social Security Analyzer or Social Security Advisor or Covisum or Income Conductor. There's all sorts of programs that can help you help your clients make the best claiming decision possible.
Yeah, it's not like advisors are walking around with the palms memorized, right?
Exactly. Hey,
Now,
2,700 rules govern those benefits. You have other things to worry about. Let me help you make your Social Security decision.
I'm game for that. So, talk a little bit about divorce. I think this is one of the more complicated topics. And before you talk about divorce, we talk about 62 being the age at which most people can claim Social Security, but there's an age 60 also rule in there too, isn't there somewhere?
Correct. For survivor benefits, they're different in that you can claim them as early as age 60. But again, they're reduced even further. Instead of getting 100% of your late spouse's benefit if you claimed at your full retirement age, if you claimed at 60, it would only be worth 71.5% of that late spouse's benefit. And then, of course, if regardless of your age, you could be 40 years old and have two little kids, because dad died, the children are entitled to benefits up until the age they're 18. And you, as the caregiving parent, are also entitled to a benefit regardless of your age until the youngest child turns 16. But then again, those benefits are subject to earnings restrictions. So it only works if you're not working or not earning too much money.
All right, let's go back to divorce. The 10 years and not remarried, et
Right.
cetera.
So divorce,
Oh,
again,
oh,
it's my favorite thing because there's so many exceptions. The basic rule is you must be married at least 10 years. And now 9 years, 11 months, and 29 days does not cut it. It's got to be 10 years or more. You must be divorced and currently single. Now, maybe you married somebody else in between and that subsequent marriage ended due to death or divorce. You're currently single. If you get to retirement age and your ex spouse's benefit is bigger than your own, remember a spousal benefit is worth 50% of the worker's benefit, then you are entitled to the larger of the two amount, your retirement benefit or a spousal benefit based on your ex. Now, for currently married couples, the way the rules work are if you're not entitled to a benefit of your own record, you can get a spousal benefit once your husband or wife claims. Now, picture a really ugly divorce and your ex spouse says, I am never going to retire and you are never going to get a dime of my Social Security. Well, Congress thought that might be a problem. So there's this exception that says, in addition to being married at least 10 years, divorced and currently single, if you have been divorced at least 2 years and both of you are at least 62 and eligible for Social Security, you can collect on your ex even if your ex has not yet claimed. That is known as being an independently entitled spouse. Now, it gets even better. If your ex dies, you may be entitled to a survivor benefit. And remember, a survivor benefit is worth 100% of that worker's benefit. A spousal benefit where they're alive is worth 50%. So your ex is worth twice as much dead than alive, but most divorcees knew that anyway. And here's another exception. If you are married at least 10 years, divorced, and you wait until age 60 or later to remarry, you can't collect on a living ex, but you can collect on a dead ex. So the two things advisors need to know is there must be at least a decade between I do and I don't. And if you're going to take a second trip down the aisle, wait till 60 to do it.
yeah. All right, you sort of mentioned disability a second ago. That's one of the more complicated topics, SSDI. Anything more to add in addition to what you've already described?
Right. Most advisors don't get involved in disability, but because there are experts that handle that very complicated program. But the basic rules, think of Social Security, it's like disability insurance. If you're become terminally ill or can no longer work. It's like a pension in that when you retire, you get this life kind of income. And it's like life insurance that if you die, your family dependents will get some sort of benefit. When it comes to disability, it's a long, arduous process for most people to apply and be approved for disability. In some diseases are fast tracked and the process is quicker. If you are approved for Social Security Disability, SSDI, the amount you receive is generally close to your full retirement age benefit amount. There's no reduction because, say, you got it at 56 or 58. But once you get to your full retirement age, those checks switch automatically from becoming Social Security disability benefits to Social Security retirement benefits. Technically, they're being paid out of two different trust funds, but your amount remains the same. So if you are approved for Social Security disability, say in your 50s, you'll keep getting that. But once you reach full retirement age, it is now a retirement benefit, but the amount remains the same. The thing to keep in mind for spouses, let's say my husband, I don't know, is 60 and receives Social Security disability benefits. Once I am 62 as a spouse, maybe I don't have a Social Security retirement benefit on my own earnings record, I am eligible to claim as a spouse on my husband or wife's Social Security disability benefit. But ages apply. If I claim before my full retirement age, that benefit as a spouse is also reduced.
One of my favorite topics has to be the exceptions for public employees, WEP and GPO.
Right. Let's start there. Social Security is a you must pay to play kind of game. The way it works is as an employee or even a self-employed person, you pay 6.2% of your gross wages up to a certain cap. This year it's $162,200. You pay FICA taxes up to that cap. If you earn more than that, you no longer pay FICA taxes on that excess for the portion that supports Social Security. There are people, New England has several states, Massachusetts being one of them, Ohio, Illinois, Texas, California, about a dozen states where public employees, including school teachers in many cases, do not pay FICA taxes. They do not pay into the Social Security system, and consequently the rules for any benefits are different. If I have worked long enough in the private sector, which is usually at least 10 years, in order to receive my minimum number of credits, 40 credits, to be eligible for a future Social Security benefit, and I also have a pension that's based on work where I did not pay FICA taxes, I will get a Social Security benefit, but it will be reduced. It will not be the amount that it says on my estimated benefit statement. It will be reduced by something called the windfall elimination provision. Think WEP, windfall worker. WEP applies to a worker who has a public pension and their own Social Security benefit. They'll get one, but it will be reduced. And in 2023, they can reduce your Social Security benefit by up to half the amount of your public pension, but not by more than $557 a month. So you'll get something, but not as much as you think. Now, let's say you're a Texas school teacher. You've never paid into Social Security. You don't expect to get a benefit, but hey, your husband has been paying into Social Security. Can't I get something as a spouse? Probably not, because there's this more onerous rule called government pension offset, GPO, think grumpy partner. It applies to Social Security spousal and survivor benefits. And it says if you, Texas school teacher lady, have a pension, let's say it's $6,000 a month, we are going to first reduce any potential Social Security spousal or survivor benefit by 2/3 of the amount of that pension. That would be $4,000 a month. No dollar limit on that reduction. That's going to wipe out any Social Security spousal benefit and in most cases significantly reduce or wipe out a survivor benefit. So the planning tip there for advisors is if you have a couple where one spouse is affected by these offset rules, maybe the private sector spouse does not want to delay till 70, because the main reason couples want one spouse to wait till 70 to get the biggest Social Security benefit possible is to create the largest survivor benefit possible. But if your public sector spouse can't get that survivor benefit, why wait?
We've been talking a lot about strategies. The people often think that claiming Social Security is a irrevocable decision, but there are some do-over strategies to think about too.
Yes, there are several options. The first one is anybody can change their mind within the first 12 months of claiming benefits, thinking, well, maybe I didn't need it after all, or gee, I got another job. Let's stop these benefits. What you do is withdraw your application for benefits by filing Form 521, which you can even do over the phone, but there's a catch. You have to pay back any benefits you have received. And if anyone is collecting on your record, such as a spouse or a dependent child, you have to pay those benefits back as well. Now, why would you want to do it? It wipes the slate clean as if you have never claimed Social Security. So at a later date, when you're older and your benefits are worth more, you claim them as if for the first time and get that bigger amount. But frankly, a lot of people don't like the idea of having to pay back those benefits, so it's a non-starter for a lot of people. You do have a second opportunity, but now you have to wait until your full retirement age or later. At that point, you can suspend your benefits. That means those nice monthly checks you've been getting, technically they're direct deposits for most people, they'll stop. But now they're going to start earning those delayed retirement credits of 8% a year up until age 70. If you suspend your benefits and do nothing, they will automatically start again at 70. But you could change your mind, maybe suspend at 67 and decide at 69, okay, I want them, just called Social Security. They'll start them again, but you will only earn those delayed retirement credits for the period you actually suspended benefits. Now, word of warning, if you have a spouse or dependent child collecting on your record and you suspend your benefits, their benefits are going to stop too, except in the case of a divorced spouse. If you have an ex collecting on your record and you suspend your benefits, it will not affect the benefits of your ex.
So we've talked a lot about sort of these high-level concepts in a way, Mary Beth, but getting into the weeds, people need to apply for benefits, and they have to do it typically online. What do advisors need to know about this process?
I highly encourage people to apply for benefits online because it's easy, it's quick, it's fairly intuitive, and the computers generally don't screw up. This will not be as much as a problem going forward, but when we had lots of creative claiming strategies available and you were dealing with many of the hardworking Social Security reps who do a great job, but they're overworked, they're underpaid, for all during the pandemic, most of them are working from their kitchen table, and sometimes you didn't get the best advice. When, for example, if you are someone who is eligible to file a restricted claim for spousal benefits only because you're born before 1954 and your spouse is already claimed, you go on to SSA.gov, Social Security Administration.gov for government. Get to the homepage, just find the piece that says apply for benefits. You click on that. And if you, identify yourself by your name, address, birth date, Social Security number, and some other details, and when you apply for benefits, if, say, you're married and it'll ask you about your spouse, it will recognize that you're born before 1954. And it will actually say if you're entitled to your own retirement benefit and that as a spouse, do you want spousal benefits only? Click yes. It's a really simple process. Now, if you do that, you have to remember when you turn 70 to start a new application online because now you're applying for your own benefits to collect your maximum benefit at 70. That is not an automatic process. For everybody else, most people now don't have those creative claiming options available. You just go online, fill out the forms and just tell them when you want your benefits to start. You can apply for benefits up to 4 months before you want your benefits to begin. Now, the one thing to keep in mind is if you're a survivor, you cannot claim survivor benefits online. You will either have to call Social Security or visit in person.
What role does the advisor play in helping their clients apply online?
Well, some advisors will actually bring their clients into the office and sit down with them, perhaps shield their eyes from the screen to see all the specifics, to help them because people are very nervous. This is a benefit they have been waiting more than 35 years to collect, and they don't want to screw it up. And a lot of people want someone to hold their hand and walk them through it. For advisors who can or won't do this for their clients, there are third party services that specialize in creating Social Security claiming recommendations for the maximum lifetime benefits. And for an added fee, they can take that next step and actually help your clients apply for their benefits.
Right. Um, Before I move on to how benefits are taxed, which I think is a pretty weighty, meaty subject, when I think about two things, one is your benefit statement is a gross amount and may not be the exact amount that you'll receive for a couple reasons. One is Medicare Part B premiums, which you sort of referred to. Those will be deducted. WEP or GPO may apply. Those things aren't necessarily reflected. And then when we think about how Social Security is taxed, let's move on to that. That may not be reflected either.
Right, exactly. I think everyone 18 or older should set up their own Social Security / my account so that anytime 24/7, you can see what your future benefit estimates will be. And it makes the assumption that you continue to work and earn approximately what you're earning now up until full retirement age. So obviously those estimates can change if you stop working or you get another job and you make a lot more money, but it's really good to keep tabs on it. It's your employer's responsibility to file the paperwork each year saying how much you earned and how much of that was paid into Social Security in the form of FICA taxes, but it's your responsibility to check it at least once a year to make sure your earnings were reported correctly. If you know you made $80,000 and you see a zero reported for that year, that's a problem. And you need to contact Social Security to get it corrected because your future benefits are based on the accuracy of your current earnings being reported. Now, as far as taxes, we know that while we're working, we pay FICA taxes to fund Social Security benefits. And guess what? They're not funding our future Social Security benefits. They are paying for the benefits of today's retirees. Could be your parents, it could be your grandparents. And you're just hoping that when you get to retirement age, those younger workers will be paying their FICA taxes to fund your benefits. But if you claim Social Security benefits before your full retirement age and continue to work, not only are you paying FICA taxes into the system, but if you make too much money, you might temporarily lose some or all of your Social Security benefits. So my number one rule for people is if you continue to work, don't claim benefits early. It just doesn't make sense. Wait until you get to the full retirement age when the earnings restrictions go away. And now, once you retire and actually claim your Social Security benefits, guess what? You're probably going to pay income taxes on those benefits because the threshold for taxing your Social Security benefits is extremely low. It was set in 1983 and never indexed for inflation. And your benefits are taxed when your combined income, which is defined as your adjusted gross income, that's generally everything on your tax return, plus half of your Social Security benefits, plus any tax exempt interest if you invested in muni bonds, if all that's your combined income, exceeds $25,000 if you're single or $32,000 if you're married filing jointly, you will be paying income taxes on a portion of your benefits. Worst case scenario, up to 85% of Social Security benefits can be taxed at your ordinary income tax rate.
Yeah. We've mentioned Medicare. Talk a little bit about the interplay between Social Security and Medicare and what folks need to know about that.
Well, I think Medicare and its costs are the biggest shock for most retirees. A lot of people think they're going to turn 65, sign up for Medicare, and never pay another dime in healthcare. And nothing could be further from the truth. Medicare Part A, which it covers hospitalization, is, quote, premium free because you've paid for it with your FICA taxes all through your career. Medicare Part B pays for doctor's fees and outpatient services, what we think of as typical health insurance. That has a monthly premium that is generally deducted from your Social Security benefit. For most retirees, they are paying the standard premium, which is about $165 a month this year for Part B. But if you are single and your modified adjusted gross income, which is your AGI plus any tax exempt interest, exceeds 97,000 if you're single, or double that, I had to do that quickly, 194,000 if you're married finally jointly, you're going to pay more for Medicare. And depending, there's 6 brackets, and as your income goes up, so does the Medicare premium. You could be paying more than $500 a month per person just for Medicare Part B. And there's also what is called an IRMA surge charge, which stands for Income Related Monthly Adjustment Amount, that is applied to your Medicare prescription drug plan as well. So I think one of the great roles of financial advisors is to work with their clients in their late 50s and early 60s to plan ahead for what could be very high Medicare premiums and taxes, and to do what they can in that long runway we now have before we have to take required minimum distributions of getting some what is tax deferred retirement savings into tax free assets like Roth IRAs, cash value life insurance, and for people 70 and a half or older to use qualified charitable distributions from their IRA directly to charities. It won't show up on their tax return and it won't boost their Medicare premiums.
Right. And it's probably worth noting that there's a 2-year look back on determining these IRMA charges, and they're not necessarily forever, right? Because of it varies, it could vary from year to year depending on your income.
That's an excellent point, Bob. That's the most confusing part of Medicare is your premiums, for example, this year in 2023 are based on your last available federal tax return, which by definition is 2 years ago. It's your 2021 tax return that you filed in 2022. And that's going to say whether you pay IRMA or not. Usually you get a notification letter in around Thanksgiving that basically says, hey, good news, you made too much money, now you're going to pay more for Medicare. If your income has gone down since that last available tax return for one of 7 life-changing events that includes things like retirement or reduced hours or divorce or widowhood or marriage, you can appeal those IRMA surcharges just by filling out the form on the notification letter and saying, please review, my income has declined since the number you are using for this IRMA surcharge. But let's say people get upset because, well, my income went up because I sold a vacation house, or my income went up because I made a Roth conversion and all that extra money boosted my income. Well, your income went up, which means 2 years later, your Medicare premium will go up. But if in subsequent years your income goes down, so will your Medicare premium.
All right, so let's tackle the big elephant in the room, which is the trustees refund. Trustees report suggests that the trust fund will be depleted come 2033, and scheduled benefits could be reduced by, I forget the exact numbers, at the 20 some odd percent.
Yeah,
Or
right. I
so.
think the latest is 23%. Yeah, let's round it off.
23%.
20, 25. The
Yeah.
thing is, what does depletion means? It means for the last nearly 40 years, we have been collecting more in FICA taxes than we needed to pay Social Security benefits. And for the first 30 years, it just kept growing to nearly $3 trillion. Around 2010, when the first of the boomers started retiring and the economy was recovering from the previous financial crisis of 2008, 2009, it was the first time that ongoing FICA tax revenues alone were not sufficient to pay promised Social Security benefits. So, for the first time, we also had to start tapping the interest that was being earned on the trust fund dollars. That was fine till about 2021. Of course, we had the pandemic that created some of the problems. So, FICA tax revenues, interest on the trust fund, together, not enough to pay all the promised benefits. So now we have started drawing down on the trust funds themselves. If Congress did nothing between now and about 2033, the forecast is those excess reserves will be gone completely. That does not mean Social Security is bankrupt. It means there would be enough ongoing FICA tax revenue to pay about 80% of promised benefits. But frankly, no one is going to be satisfied with 80% of promised benefits. There's a lot Congress can do between now and then, but they don't tend to like to do things before they have to. The last time there was major Social Security reform was in 1983, and it's when Social Security was not going to be able to pay all promised benefits. So at the 11th hour, they fixed the system, and no one ever missed a Social Security check. It's quite possible that could happen again. This could be 2032, 2033. However, the problem is bigger now than it was back in 1983. And while it's true, they could do things like raise the full retirement age from 67 to maybe 70 for today's 2-year-olds who will have decades to get used to it. And frankly, they'll probably live to 120. They can deal with it. They could raise taxes, all sorts of things they could tweak. But personally, I think, and you're starting to see a lot of Social Security experts write on this, like the Center for Retirement Research at Boston College. Alicia Minot just recently wrote that there's probably going to have to be some sort of infusion of general revenues, at least temporarily, to get Social Security over the hump. I know Senator Bill Cassidy, a Republican in Louisiana, has been promoting his big idea of having a separate dedicated fund of government money that could invest in the stock market, and those earnings would be used to supplement the Social Security Trust Fund. One of the challenges is the Social Security Trust Fund can only issue special issued treasury bonds, which earn about 2.4%. Now, over the last year, stock markets in general were returning a lot higher than that. And many people have argued that we should be investing some of these funds to get a bigger return. So there are lots of things they could do. The key is they must do something, and the sooner the better.
Yeah. So
So
if you're a financial advisor with clients, would you recommend that they sort of have a best case, worst case planning scenario, that they sort of adjust their plans to say there might be a 20% haircut in your Social Security? Or as we think about the potential solutions, the highest income earners, and I'm guessing the youngest income earners, are those that will be most affected by any changes with respect to higher taxes, lower benefits, or a combination thereof?
Well, I think if history is a guide, it is highly unusual for Congress to cut benefits of existing or near retirees 10 years from now. And that's no guarantee they won't, but I think there would be heads on pikes. The protests would look like France, setting bonfires on the Capitol. So I can't swear what they're going to do, but I think that scenario is unlikely. However, if I want to be prudent, and I have clients, high earning clients particularly, in their 50s or younger, I think I'd say, all right, here's your projected Social Security benefit. Just for the heck of it, let's reduce that by 25% and plug it into your overall retirement income plan. Now, we're not saying your overall retirement income is going to be cut by 25%. We're talking that the Social Security portion, which for your clients may be representing 25% or less of their pre-retirement earnings. I think that's doable. And if there's a shortfall, what can we do now to make sure there are more assets later? I think from a tax standpoint, you will see higher taxes for future retirees, both in the form of what they're paying for Medicare premiums, which are deducted from Social Security, and I think it's not unlikely that 100% of Social Security benefits could be taxable in the future, but at much higher thresholds, maybe starting at 50,000 for singles and 100,000 for married couples filing jointly. There are over 100 proposals floating around out there to reform Social Security. And if you really want to get into the weeds, you can go to ssa.gov and click on the Office of the Chief Actuary. And Steve Goss and his staff compiles proposals every year of ways to improve the financing of Social Security and how much of the trust fund depletion each of those proposals would deal with. It's a really interesting exercise.
Mary Beth, we've covered a lot of ground. Anything we missed or anything that just bears reemphasizing before we wrap up?
Well, as many of you know, I write for Investment News, but I also launched my own free website called marybethfranklin.com. Imagine that. And I have several free articles on that you can share with your clients of best time to claim benefits based on their marital status. You can also order a copy of my ebook, Maximizing Social Security Benefits, there at the website. And if you would like to book me for presentations for your professional financial groups or for a client event, you can reach me through marybethfranklin.com.
Mary Beth, it's been such a pleasure having you share your knowledge and wisdom with our listeners. It's so greatly appreciated. Thank you.
Thanks, Bob. I really enjoyed it.
Thank you for listening to the Exceptional Advisor podcast brought to you by the Investments and Wealth Institute. If you've enjoyed this podcast, please subscribe through iTunes, Spotify, or our website at www.investmentsandwealth.org/podcast to get the latest episodes of our Exceptional Advisor podcast series. For additional resources, updates on events, and exclusive membership deals, visit www.investmentsandwealth.org.